Okay, good morning, grad time business. Today, still with me, Ms Mega. We will learn about accounting. So today, we are topic still the same topic, but this one is for part two. So I will give our PPT for today. So here are our PPT. The title is the same. Of interpretation of accounting ratio. It means we are want to understanding how to interpret our accounting ratio, but this one is for part two. So if you want to see the learning outcome, so by the end of this chapter, you will be able to prepare and comment on simple statement showing comparison of results for different years. So we already do this before. Make recommendation and suggestion for improving profitability and working capital, understand the significance of the difference between gross margin and the profit margin as an indicators of a business efficiency, and explains the relationship of gross margin, gross profit for the year to the valuation of inventory, rate of inventory turnover, revenue, expenses, and equity. So there are our learning outcome. So if we see from here, the significance of the difference between the gross margin and gross gross profit as an indicator of efficiency. In here, we do have like gross margin and the gross profit. The difference between them is the expenses itself. If we see the expenses is very higher, that could be as indicator that business is inefficient because they are not really they are not really good in manage their expenses. So that's one significant that we can find from the results from the gross margin and gross and profit margin. So there are like some ways to improve working capital and the cash position of the business. But before we must know what is a working capital. Working capital is like the ability of company to pay all their current liability using their current asset, or the working capital is like how we see the difference between current liability minus current asset. So in terms to see the working capital is good or not, we can use the current ratio. So the current ratio is that the one of the ratio that we are fine using the current asset divided by our current liability times 100. So that's we can find the working capital. The meaning is if the working capital is good, they have like some ideal ratio. 1.5 per 1 is the ideal one. So all 1 per 1. So below 1.5, that could be means that the business cannot pay all their current liability using their current asset, which is not good. But if the ratio is more than 1.5 per 1, let's say example 2 compared to 1. It means they have more twice current asset compared to the current liability, and this condition is still not good. Because it means the business cannot use all of their asset. They are not really good in terms of investing all their asset to use or to manage their current asset. So it's not really good also if our current asset is much more bigger than our current liability. So they have like the certain idea of ratio. So in terms of it, working capital can be improved. So we need to improve our working capital by injecting, put more cash into the business. So in put more cash into our business, we can do by selling our fixed asset, let's say our building, take long-term loans, and that kind of things we can do that can increase our current asset. But using that things in a short terms, that could be we can it's very easy for us to make our current asset, but in terms of long terms it's not really good because if we're selling our asset, that means our fixed asset, that means we might need that fixed asset when we sell it, right? So it's in terms of short terms, it's good, but in terms of long term, it's not. It's very, it could be not good. So there are like some other measures that we can do to improve the cash position of the business, like reducing credit sales and increasing cash sales. So this is kind of the policy that we can do, because by reducing credit sales, it means reducing the possibility for our customer have low, we give loan to our customer. It comes with reducing our trade receivable and we increase our cash. So we want to choose more on the cash sales. And the second one is delaying the payment of trade payable, because if we pay our trade payable, it means we decrease our cash. So by delaying the payment of trade payable, it can keep our cash still inside our business. Okay, and then the next one is reducing the credit period allowed to customer. So there are like other measures of a business liquidity. That means there are other measures to find out whether the business have a good liquidity or not. Remember, a business really need a good liquidity. I mean, the business really have more asset, have more liquid, or the business have capability to pay all of their liability using their asset. That's the business liquidity means, or the ability of the business to pay all of their short liability. The first one is the trade receivable turnover. The trade receivable turnover is the ability of the customer, of the ability of a business to to in terms of the how much time the customer take times to pay all the debt. So that's the meaning of trade receivable turnover. A good trade receivable turnover, there will be shorten times the customers to pay all their debt, because if the trade receivable turnover is very longer, it means the customers not really willing to pay all their debt on time, or that this is really a bad liquidity for the business, because getting the longer time the customers pay off their debt, so it means the longer time for us to have our cash, the longer time we have our cash, so it means the liquidity of our business is not really good. So that's the first ratio. The second ratio is the trade payable turnover. This is the rate of a business or R to pay all our debt to our suppliers. So the trade payable turnover. So the trade payable turnover is not good for us to pay longer, because it means that we cannot pay our bill on time. That's really not good for our business. But very short time for us to pay our trade payable is not really good also. And we must pay our bill at the right time, because we really want to pay our bill in the right time, so maybe we can get some trade discount or the cash discount. So it's very good. That's a good gain to our business. The third one is the rate of inventory turnover. Rate of inventory turnover is the how much time our inventory takes to come and out. Remember, inventory is like the core activity of the business, because if the inventory come in, it means we purchase. But if the inventory is go out, it means we are selling the the product. So the rate of inventory turnover is really crucial in terms to judge, to evaluate the business have a good liquidity or not. So we are using these three ratio also. So relationship of profit to inventory, revenue, expensive, and equity. So we want to find the relationship of them. Inventory equals the gross profit and consequently profit for the years. If you still remember the formula of the profit for the year and the gross profit. Remember, if we want to find the gross profit, the formula is sales minus cost of sales. So if how to find cost of sales? Cost of sales is opening inventory plus purchase minus the closing inventory. It means if there is something changed with our inventory, that could impact our gross profit as well as the profit for the year. Because profit for the year, the formula is gross profit divided minus our expenses. So it is therefore important to use the right valuation of inventory. If we see from the example, inventory is valued at the lower of cost and net realizable value. If closing inventory is undervalued, that means gross profit and profit for the year will be also undervalued. Therefore, gross margin and profit margin will be undervalued as well. The opposite also happen to if our closing inventory is overvalued, it means our gross profit for the year will be overvalued, and therefore the gross margin and profit margin will be overvalued as well. Now, if you see from the example, the middle one, inventory at the right value is 4,500, but if the inventory under value, let's say it's become 4,000 and overvalue 5,000. If you want to calculate the gross profit will be do effect, as I said before. So the gross profit at the right value 4,000, but for the under value, so the gross profit under value as well become 3,500. If the inventory overvalue, the gross profit will be overvalue 4,500. Let's say they do have the same sales, they do have like the same opening inventory. It's about 3,000, and then they have like the same purchase 7,500. But in terms of gross margin, because the gross profit is have effect, that could be also effect our gross margin. How is that? Because gross margin, the formula is gross profit divided by sales times 100. In the right inventory, the gross margin is 40%, but for the inventory and the value, the gross margin also decrease become 35%. But the inventory overvalue, the gross margin is become overvalue become 45%. That will increase. So if we find from the profit for the year, the right inventory is 1,500, but the one with the undervalue become 1,000 and the overvalue become 2,000. So it's also effect as well from the profit for margin, because profit margin, remember profit year divided by sales times 100. That could be even the right value for profit margin is 15%, but for the undervalue become 10%, overvalue become 20%. And how about the inventory turnover? Inventory turnover have the opposite one. If we see from here, inventory turnover at the right value is 1.6 times, right? But if the inventory is undervalue, the inventory turnover become overvalue, become 1.9 times. And if the inventory overvalue, the inventory turnover become undervalue, become 1.5 times. So why is that? The rate of inventory turnover will be affected by an incorrect valuation of closing inventory. So the formula of rate of inventory turnover, that will be cost of sales divided by average inventory. Remember what's the formula of cost of sales? So cost of sales is just opening inventory plus purchase minus closing inventory. So when inventory is undervalued by 4,000, that could be the rate inventory will be turned into 3,000 plus 7,500 minus 4,000 divided by 3,000 plus 4,000 divided by 2. This is the average inventory. Opening plus closing divided by 2. That could be we find 1.9 times. That means increase from the right value is 1.6 times, right? What about the inventory and the right value is this 4,500? This is 1.6 times. What about the inventory is overvalued by 5,000? Overvalued by 5,000, the rate of inventory turnover will be 3,000 plus 7,500 minus 5,000 in here. So divided by 3,000 plus 5,000 divided by 2, there could be 1.338 times. So they will be have the different number also and do really effect. If we want to find relationship to revenue, a business main source of income is sales revenue. Yes, it is because the want to find profit, gross margin. Profit is sales minus cost of sales, so which is found in the income statement along with the gross profit and profit for the year. So, sales revenue is really very important in terms to bind to calculate the right ratio. So if we hear from the example below, the sales at correct value is about 10,000. If the sales under value, it become 9,500. Sales over value is 10,500. Let's see the cost of sales is still the same, 4,500. But the gross margin will be different. Why? Because the gross profit is sales the minus cost of sales of 5,500 minus 4,500, 5,000. 10,000 minus 4,500 is 5,500. As well with the overvalued sales, the gross profit also overvalued becomes 6,000. So what about the gross margin? Also effect. So it is also for the undervalued sales, the gross margin is undervalued as well, become 47.3. But for the sales overvalue, the gross margin is overvalued also, become 57.1%. For the profit for the year also effect because the sales, right? And profit per margin is also effect as well. The profit margin at the right sales is 15%. But for the profit margin and the sales under value, this profit margin under value become 10.5. But for the profit margin, the sales over value, the profit margin become 19%. It increase. So how about the relationship to the equity? Relationship to the equity, if you really find out, profit for the year is gross profit minus expenses, right? The relationship between profit for the year and owner's equity is true profit plugged back into the business as the profit are added to the owner's equity and losses are subtracted from the owner's equity. So if we do find the different at the right profit for the year, there will be effect the equity because if the business have profit, so the profit just added to the equity. But if the profit have loss, so the loss will decrease the equity. So both of them will be affect our equity. So return on capital or ROC measures the profit before interest as a percentage of capital employed, right? So owner's equity is the capital employee if there are non-current liability. So basically they do have like relation with the equity, expense, and so on. That's for the today lesson. So I will do have like a quick review, like a quick question. So this is the exam styles, the question. This is the example that might be for our quizzes. For number one, which ratio indicates whether or not the business has a good control of its expenses? Remember, expenses. So it's all to the profit margin because profit per year we can find out. So the answer is profit margin. So what does a comparison of this liquid ratio indicate? If we see the 2018 1.3 compared to 1, 2019 0.5 compared to 1. So it means the liquidity of the 2019 is lower compared to the 2018. So the answer is C. Very easy, right? Okay, the number 3, Shirley decided to improve her gross margin. Remember, gross margin is gross profit divided by sales times 100. What should we see do? So if we want to talk about gross profit, so there is no relation with expenses. So R and D is totally wrong. But the right one is the B, reduced rate of cash discount alone. So the last one, this is the last one. Which of the following is not a profitable ratio? Remember, profitable ratio that could be gross margin, profit margin, and ROC, return on capital. So not profitable ratio is the liquid ratio, because liquid ratio is just to find out whether the business is liquidity or not. So that's, I think we just discussed for 4 questions for so far. This is like similar with our exam. So at the last, I do have some quote: keep calm and carry on. The only things we have to feel of is fear stuff. So don't worry, be happy. So okay, just don't worry, be happy. Please stay at home, do your assignment. Don't go outside. Just for very important things, go outside. Just stay at home. Please keep the physical distance. So that's all for today. If you do have any question, you can directly ask me. So bye-bye.